Assalamu alaikum. Welcome to lecture 8 of taxation, which is pension. Earlier, I have covered till property income. So I've covered investment income, self-employment income, employment income, property income, and now I am into pension. Pension is also another form of income which one receives after their retirement. So one should know how to account for this, okay, under the income tax. So let's start. Here we are going to focus on types of registered pension scheme, tax relief for pension contributions, the method of obtaining that tax relief, how do you access the pension fund, the lifetime allowance. Then we are going to do some practice objective test questions and the summary. So let's start with the overview of this lecture. Okay. Under registered pension scheme, okay, both can contribute. The one who is employed and also the one who is not employed. Okay. If they are employed, they have two types of pension scheme. And you should remember this. You should know the difference between these two. One is occupational pension scheme. The other one is personal pension scheme. Soon we are going to learn the differences between these two and how you account for it. Okay, personal and occupational. Personal pension scheme, one could also contribute if they are not employed. But occupational pension scheme, to contribute, you have to be employed. Okay, personal could be for both employed or non-employed. Occupational is only for employed. Then under both the scheme, you have to know how do you get the tax relief, then method of obtaining that tax relief, then how do you calculate annual allowance charge, how do you assess the pension fund and impact of lifetime allowance. So let's start with pension. Okay, what do you invest in pension? Pension scheme, okay, is a very long-term investment. Therefore, it's very tax efficient. Pension scheme is tax efficient for this following reasons. Number one, you can get tax relief. If you contribute in a pension scheme, you get tax relief. That means you pay lower of the tax. You pay less tax. That means government is promoting contribution in the pension scheme. That's why they're giving you this tax relief. Next, if an employer contributes into the scheme, there's a tax relief for the employer. Okay, so there's a tax relief for the employer contribution without being a taxable benefit for the employee. Then pension scheme can also grow tax free. Why? Because this scheme is exempt from income tax as well as capital gain tax. We haven't covered capital gain tax yet. Okay, that we are going to cover later. But know that it is exempt from both of this tax. So isn't it a good news, guys? Okay, then when you take the pension, okay, after a certain age, you will be using that pension. That fund can be withdrawn as a tax-free lump sum, because it's a huge amount. At once you can take without paying tax. Now, there are two main types of pension scheme, and these two main are the whole body of this lecture. One is occupational, other one is personal. Now, as we have seen in the diagram before, self-employed or unemployed, both can contribute in a personal pension scheme. But for occupational, you have to be employed. Okay, so, but you have to be self-employed or unemployed for personal pension scheme. Okay, then occupational pension scheme. This scheme, it is set up by a specific employer for the benefit of his employee. As the word occupation, you can understand. Okay, so contribution into this scheme can be made by both the employer and the employee. Now, This is types of occupational pension scheme. Please understand the subdivision. First, it is personal and occupational. Under occupational, we have two types. We are more worried about occupational than personal here. One is defined benefit, the other one is defined contribution. Defined benefit is, okay, the benefit, okay, that you are taking are linked to the level of earnings of that employee during the employment. And the next one, defined contribution, also known as money purchase. This is the benefit is dependent upon the performance of that investment held by the pension fund. Okay, now personal pension, any individual can contribute here. Employed, self-employed, those not working, including children. So contribution into the personal pension scheme can be made by individual and any third party on behalf of an individual. They can make this contribution. It could be employer, it could be a spouse, it could be a civil partner, parent, grandparent, anyone. Now, overview of the tax relief rules for pension scheme. This is how tax relief works, okay? Amount of the tax relief. Remember, amount of the tax relief available is same for both the pension scheme. Whether it is occupational, whether it is personal, does not matter. The amount is same. Okay, but the method of obtaining that benefit is different under both the scheme. That you should understand. Amount is same. Method is different. Now, once funds are invested in a scheme, all pension schemes are governed by the same rule, whatever scheme it is. Then, tax relief is available for pension contributions if both. You need to know this. You can't get tax relief for any pension contribution. It has to be under a registered scheme. That pension scheme has to be a registered scheme. If it's unregistered, no tax relief. But for your exam purpose, you should always assume whether they mention it or not, the scheme is registered. Okay. Next, individual has to be a resident in UK and aged under 75. These are the two rules. So, regardless of the level of earnings, see, your contribution is not linked to your earnings, okay? Your earnings could be anything, okay? And a person could contribute any amount. There is no such limit that you can't contribute beyond this amount or it can't be less than this. No. An individual can make any amount of contribution into either pension scheme or number of different pension scheme. It could be one pension scheme only or different pension scheme. A person could have 2-3 pension schemes also, right? Possible. Now, but the tax relief that you are getting is available only up to a maximum annual amount. Annual because every year that amount you will get. Maximum amount each tax year. And this tax relief is available on contributions up to the lower of. This is what you have to remember for your calculation purpose. You have to memorize this part. Number one, lower of this two. First is you have to check what is your gross pension contribution, gross. Then you have to compare this with the maximum annual amount, and that maximum annual amount again is higher of this two, 3,600, and your earnings. 100% of an individual's earnings, relevant earnings, relevant. What is that relevant earning? Relevant earnings include 3 types of income. Trading profit, taxable trading profit, employment income, profits from furnished holiday lettings, but not investment income. You should not take investment income. Whenever investment income comes, you have to not take it. It does not come under relevant earnings. Okay, so it is your taxable trading profit, employment income, profit from furnished holiday lettings. Add this 3, 100% of it means that is the amount only. So if this is higher than 3,600, then that would be your maximum annual amount. If your relevant earning is less than 3,600, then 3,600 is your maximum annual amount. This you have to compare with your gross pension contribution, number 1, and check which one is the lower of those two. On that amount, you are going to get the tax relief. Understood? Don't worry, we are going to do enough questions on this topic. Next, The maximum annual amount applies to the total gross contributions made into all the schemes where, see, this annual amount, this maximum annual amount that we have just talked about in the previous slide applies to all schemes. It applies to where an employee contributes into both occupational or personal, or an individual contributes into more than one personal pension scheme. Each personal pension scheme will have that amount. Okay. Then, if an individual has no earnings at all, don't worry. Still, up to 3,600, he would get tax relief. Okay, without any earnings, zero earnings. Now, let's summarize this whole thing before we attempt a question. First, registered pension scheme, which is occupational and personal. Then we have contribution by individual. Okay, tax relief is on the lower of these two. First one, total gross contributions. Next, maximum amount is higher of 3,600 and the 100% of an individual's relevant earning. Relevant earnings are taxable ready profit, employment income, furnished holiday lettings income, but not investment income. If you remember this summary, you have understood everything. This is the only thing which you will be tested. You have to remember this till here. Later on, we are going to learn something additional to it. Okay, so now let's attempt a question. Illustration 1. Okay, here you have to explain the maximum amount for which tax relief is available. Okay, now on one side you have gross contribution, on the other side you have relevant earnings. You have 4 different people. So let's start with Karima. Karima has 2,500 gross contribution, no relevant earnings. Okay, so since no relevant earnings, higher amount is 3,600. As we have told, we have to choose the maximum amount higher of 3,600 and 100% of relevant earnings. So no relevant earnings, 3,600 is a higher amount. Now out of this two, you have to check the lower. Okay, that will be the amount of tax relief. So the lower is 2,500. So tax relief is 2,500. You have to explain here. Why? Because no relevant earnings, higher is 3,600. Then pension contribution is less than 3,600, lower. So that's why 2,500. Next, Nadia. Nadia also higher is 3,600 because no relevant earnings. Cross contribution is more this time, 6,000. So what could be the tax relief? Lower, which is 3,600. This time relevant, this amount is lower. You can explain here. Third situation, Kenza. Kenza has 75,000. If you take 100% of 75,000, it is 75,000 and 3,600. But the higher this time is 75,000. You have to take the lower of this two, 36,000 and 75,000, which is 36,000. So the tax relief is 36,000. This is how it works. Yasmin, 100% of 38,000 is 38,000. 3,600 is lower. So you have to take higher. Then lower is this time relevant earnings. Contribution is more. So tax relief could be 38,000. Are you understanding the situation in each of this? I will tell you. First step. Step number 1. Okay. Higher between 3,600 and 100% relevant earnings. So, okay. Once you choose higher, you keep an amount. Either it will be 3,600, either it will be more than 3,600. It can't be less than 3,600. This is what you have to understand, visualize. An amount cannot be less than 3,600. Understood? Then lower of gross pension contribution. Lower of gross contribution and step 1. Whatever the amount you get from step 1. That amount you have to compare with the gross contribution. Whichever of the two is lower, on that you get tax relief. This process only you have to understand. That's it. And every now and then you have to apply this. So now let us go to the Next topic. Now, the next is how do you obtain the tax relief? As I told you, under two schemes is different. Amount is same. First, we are going to work through personal scheme, then occupational. So under personal, okay, see, whoever contributes, method is same, okay? Contribution could be made by employee, self-employed, individual is not working. Next, there are two types of relief. One is at the basic rate, the other one is at the higher and the additional rate. Okay. Basic rate tax relief is, this is given at source. When the contributions are paid, at that time itself, it is deducted at source. So that means an individual is making contribution net of the 20% tax. Why? Because basic rate is 20%, right? Basic income tax is at 20%. So you make contributions net of the basic rate of income tax. Next, contributions. Whoever makes a contribution into a personal pension scheme, okay, they benefit from this basic rate tax relief. Okay, even if the taxpayer is paying tax at the starting rate, higher rate, or not paying tax at all, whoever contributes into personal pension scheme will get this benefit from this basic rate tax relief. Okay, now HMRC pays the 20% tax relief to the personal pension scheme. You'll see how it works with numbers, don't worry. Next benefit is at higher and additional rate. This relief is obtained in two parts. First part, 20% deducted at source. Then you extend the band. You extend both the basic rate and the higher rate band. How? By what amount? By the gross amount of the contributions made. Like how we used to do earlier for gift aid donations, remember? In calculating our personal allowance, right? When we had to adjust a personal allowance, when we had to calculate net income, we used to do this. We used to extend it by gift aid donation. Exactly same. Now, next part. Okay. That means earlier, if you are paying at a higher rate, now you will pay that amount at basic rate. Earlier, if you are paying at an additional rate, now you'll be paying it at a higher rate. Isn't it a benefit? Right? So you are moving one level below. One band lower, you are being charged. You have been taxed. It's good. You are saving on tax. Next, for example, let's say an individual pays a contribution 8,000, which is net. You have to find the gross amount because you don't expand the band by the net amount. Remember, it has to be by the gross contribution. So if you are given the net amount, you first have to find the gross of it. And you should know how to gross it up. How do you gross it up? Always multiply the net amount by 100 and divide by the percentages that you have taken. Here, basic rate is 20. So it would be by 80%. So into 100% divided by 80. If it was 30%, it would be into 100 divided by 70. If it was 40%, it's into 100 divided by 60. That's how it works. Okay. So 8,000 into 100 divided by 80, you will get the gross amount. And remember, it's common sense that your gross contribution has to be more than your net contribution, right? Why am I telling you this? Because some students often make this mistake. When they calculate, they don't know how to gross it up. They do 8,000 into, sometimes they find 20% of 8,000. Sometimes they do it 8,000 into 80 divided by 100, the other way around. So in that way, you will get a lower amount than 8,000. Always check your gross amount is more than net. It can't be lower than 8,000. Okay. So 10,000. Another way of checking that you are correct or not is, see, net means you have taken 20% of a gross amount. So check 20% on 10,000. 20% on 10,000 will be 2,000. Deduct that 2,000 from 10,000, you will get the net amount, which is 8,000. Now, so earlier basic rate was 37,700. Now add 10,000 to it. Now up to 47,700 you will be charged at basic rate. Earlier additional rate was 150,000. Now add another 10,000 up to 160,000. Okay, below that you will be charged at higher rate, not additional rate. Now let's do a question. Illustration 2. Okay, you have been given pension contribution of 6 different people. You have been given the trading profit and there is no other sources of income. Now, there are two requirements. First, you have to explain how tax relief you will be given. Next, also you have to calculate the income tax liability of Don, Ed and Fran, the last 3 people. Ignore the annual allowance for now. Why? Because in your real exam, you will be given with the annual allowance. By that time, you will cover the annual allowance. Okay, this is before studying annual allowance. Okay, so let's quickly start with Andy. Okay, now Andy has no income, so he will obtain tax relief up to what? So trading profit is a part of a relevant earning. Remember, 100% of relevant earning or 3,600 higher. Higher is 3,600 in this case. But you have to take lower of this and this, 5,000 and 3,600. Lower of pension contribution gross and 100% of relevant earnings. So lower is 3,600. That's why 3,600 is the tax relief. I will just add another column. Okay. See, they told explain. Please focus on the word, the verb. What are they telling? Are they telling you just calculate or they are telling you to explain? If they're telling you to explain, you have to calculate and explain. Obviously, how can you explain if you don't have the figure with you, right? If they just tell you to calculate, then don't explain, just calculate. But here they told explain. In the next one, they told calculate. So here you have to explain why it is 3,600 tax relief. You have to say no profit on no relevant earnings, higher is 3,600, lower than pension contribution, therefore 3,600 is the amount. Okay, but it is not enough. Explain how tax relief will be given. They're just not telling that this is the amount on which you will get the tax relief. You have to calculate and tell how you are going to get that relief. Okay, so he will obtain a basic tax rate relief because 3,600 falls, it is less than 37,700. It falls under basic rate. So he will get a basic rate tax relief at source. How? He made a gross contribution. On this, he has to get some relief. How? Tax relief he will get on 3,600. So take 20%. Okay, I will do it here. If you take 20% on 3,600, it is 720. Remember, this is gross. You have to find the net contribution. You have to net it off. So how much you will pay to the pension scheme? Net of 5,000. Okay. This is gross. Net amount is minus 720. So the amount he will pay to the pension is how much? The remaining amount, 4,280. Okay, 4,280 is the amount he will pay to the pension scheme. That is for ND. Now we'll do for Brad in a same way how we have done for ND. So tell me for Brad how it will work. See, obviously 20,000 is higher than 3,600 and this 20,000 is more than 5,000. So he will only get relief up to 5,000. Okay, same way. This is the tax relief. Sorry, this 5,000 is here. This one, I mean the bread. Okay, it came in. Okay, it's here. Sorry, one line below. So 5,000. Here it's 5,000 into 20%, which is 1,000. So you deduct 1,000 from the 5,000 gross contribution for bread. That is the relief. 4,000 is to pay to the pension.
Okay. Now, Cindy. Okay. Now we are in the Cindy. So 20,000 is higher than 3,600. And when you compare it with 25, lower is 20,000. Okay. So in 20,000, he's going to get the tax relief. Okay. 20,000. Now, same way. 20,000 into 20%, which is how much? 4,000. This 4,000 you're going to deduct from 25,000 and going to get 21,000. Okay. Remember, for Cindy, Cindy is not a high rate taxpayer, so there is no adjustment that is required for her income tax. Okay. Now we are moving to Dawn. For Dawn, Ed, Fred, we have to do the same way. Addition to that, calculate income tax. So Dawn, 95. 95 is higher than 3,600. If you check it with 40, 40,000 is the lower. So 40,000 tax relief you will get. So you have to take 20% of 40,000, which is 8,000. Okay, 8,000. So this 8,000 you will deduct from 40,000. And you will get 32,000. Now, what about the income tax? Remember, please understand the level of his trading profit. Dawn is at 95. 95,000 is at higher rate. But by his gross pension contribution, you can extend his basic rate band. So by 40,000, you can expand the 37,700. This is for Dawn. 37,700 plus 40,000. Now his basic rate band will be up to 77,700. He will be charged at basic rate. So from higher, he is moving to basic. Now, question also asked you to calculate Dawn's income tax. So we'll do that. Okay. Dawn's income tax will calculate. Now, starting with the trading profit. Profit is 95,000. From 95,000, please, please, please do not forget your personal allowance from your earlier lecture. How much? You have to remember this 12,570 for this year. Then we are left with 82,430. Then that is your taxable income. Okay. Taxable income. Now charge. See basic rate. Out of 82,430, 77,700 is charged at 20%. The balance from 82,430, if you take 77,700, you are left with 4,730, which is taxed at 40%. Now you have 15,540, 1892. If you add this, 17,432. This is the income tax liability of Dawn. Now we are moving to Ed. Ed, 3,600 and 25,000. 25,000 is higher, which is lower than 60,000. So 25,000 is the tax relief. Okay. Now 25,000 into 20%, which is 5,000. 5,000 he has to deduct from 60,000, his gross pension, which is 55,000. Okay. So now, remember, He is a basic rate 25,000. So nothing to extend. Everything will be charged at basic rate. Let's do income tax of Ed. Okay. So we'll just change the name. Put this Ed. His profit is from 95. We'll change it to 25,000. Personal allowance remains the same. Then it becomes 12. This becomes 12,430. So this 12,430 entirely it is charged at 20%, which is giving you an income tax liability of just 2486. Now the last person, Fran. Fran is an additional rate taxpayer. Okay, 195 and 3,600. Higher is 195, but you have to choose this because this is lower than 195. So tax relief is up to 30,000. Okay, now 30,000 into 20%, which is 6,000. This 6,000 you have to deduct from 30,000 is gross contribution, which is 24,000. Okay, now you have to expand the band. How much? By 30,000 because gross contribution is 30,000. So basic rate $37,700 plus 30,000. It is 67,700. Then even the higher rate band, additional rate band, 150,000 will extend by 30,000. 180,000. Now let's do the income tax. Okay. So trading profit, let's go here only and just change the name Fran. I'm just going to rub it. Okay, just going to rub the amount. Okay, now profit is 195. Remember, it is 195. Beyond a certain amount, there is no personal allowance. Will you get it? His whole day trading profit is equals to his total income here. Okay, so because it is 195, you can reduce this amount by the gross contribution 195. So 195,000, this is just a rough working. If you deduct it by gross contribution, 165,000. Okay, even this 165,000 is more than 125,140. If an amount is more than 125,140, the net income. Okay, what happens? No personal allowance. Personal allowance is 0. That's why there is no personal allowance here. It will be 0. So taxable income will be 195,000 only. You have to do the small workings to check whether you will get the personal allowance or how much it will reduce or it's nil. So now, since we have expanded the band by 30,000, okay, so out of 195, 67,700, because we have expanded the 37,700, the basic rate band by 30,000. That's why 67,700 into 20%. How much? 13,540. Then up to 180, not 150, 180. So 112, 300 into 40%. 44,920. Then the remaining, it's up to 195, right? So balance 15,000 at 45% additional rate. 6,750. If you add, it is 65 to 110 is the income tax liability. Occupational pension scheme. Under this scheme, where employees make pension contribution, payments are made gross, okay, and tax relief is given at source by the employer through the payee system as an allowable deduction against employment income. Okay, now tax relief is given at basic, higher, and additional rate of tax depending on individual's level of income as follows. Employer will deduct the pension contribution from their earned income before calculating income tax, and tax relief is automatically given at source at the employee's highest rate of tax. Now let's do a question.
Test your understanding 1. Here you have to calculate Carlos' income tax liability, showing how tax relief is obtained for his pension contribution. He has an annual salary of 80,000, member of occupational pension scheme, pays 3%, and the employer pays 5% of his salary into the scheme. No other income. Okay, so old day salary is 80,000. Remember to deduct what? You have to deduct the employee's pension contribution. Employees. That means Carlo. Whatever Carlo has paid into the pension scheme needs to be deducted from his salary. Okay, because he's getting a tax relief. That's how he gets the tax relief. So employees, that is Carlos. Carlos is the employee. Okay, pension contribution less employees pension. I'm writing short form. Pension contribution at what percent? 3%. So 3% of 80,000 is 2,400. Then it becomes 77,600. Then personal allowance. Remember, when we are deducting personal allowance, first you deduct employee's contribution from salary. Then you deduct personal allowance. Do not forget this. Often students forget personal allowance. 12,570 fixed. Then taxable income.
Is 65,030. Now, then from here, you can find the income tax. Up to 37,700 is at 20%. The balance is at 40%. Okay. Now, remember, what about the employer paying 5%? Remember, whenever an employer contributes, it is an exempt employment benefit. It is not taxable income for Carlos. For Carlos, we are fighting for Carlos, not for the employer. So whatever employer pays, it is exempt from Carlos taxable income. Okay. So what happened? Because of this pension, his income reduced by taxable income reduced by 2,400. Okay, that he would have paid at 40% because he's at a higher rate, 65, more than 37,700. So the amount that he would have paid at 40%, now this amount is saved. It's reduced by, earlier he had to pay at 80, now he's paying at 77,600. So by that 2,400 is the tax saving because of his pension contribution. So that is the tax relief he's getting at what? 40%. Understood? And what about the employer? What he has to do? Liard? He will deduct this 2,400 from the amount of taxable pay, from which income tax is deducted through the pay system. You don't have to know about that right now. So now let's move on to the next. Now we are moving on to contributions paid by an employer. How do we deal with this? This is a tax deductible in calculating employer's taxable trading profit. But remember, those contribution has to be paid for the purpose of trade, not any purpose. And it is an exempt employment benefit for the employer. Just now we saw in test understanding 1, the previous question, right? For employee, it is an exempt employment benefit, but for employer, it's tax deductible from their profit. And it is added to the pension contribution paid by the employee on which tax relief is given to determine whether annual allowance has exceeded or not. In the next slide, we are going to go through an annual allowance. Okay. This annual allowance, when we are taking the amount, we add both the employer and the employee's contribution to check whether we have exceeded the allowance or not. Now, trading deduction. So, the deduction against the employer's trading profit. Remember, this deduction is given when we have paid the contribution. Okay. Here we don't follow the accrual concept. It is based on when contribution is paid. On that accounting period, we deduct from the profit. Whenever the contribution is paid, that accounting period. Now, you have to adjust the profit. How? You have to add back any amount charged in the statement of profit and loss and deduct the amount paid in the accounting period. Why? Because you must have already deducted this from the trading profit. Add back. And then deduct the amount paid in the accounting period. You have to do this adjustments to profit computation. Okay. Now, annual allowance. There is no limit up to the amount that one can contribute. It could be by individual, it could be by employer, it could be by any other party. Okay, there is no rule that says that you have to pay up to this much into the pension scheme. No limit like that. But for the tax relief purpose, there is a maximum annual allowance. That means up to this amount only you will get the tax relief. Beyond that, you will not get the tax relief, even if you put that into the pension scheme. That is known as maximum annual amount. Every year it is an amount is there. That's why annual. Okay. It is known as annual allowance. Okay. So here, how do you check the annual allowance? We add all of the contributions. All the contributions we add, whether by the individual, by the employer, by third party. Then we check whether it exists an annual allowance or not. Then if it exists the annual allowance, there's a tax charge on the excess. Annual allowance. For this year, the annual allowance for this tax year is 40,000. 40,000. And one good news is this can be increased by bring forward any unused annual allowance. Let's say this year you didn't utilize the 40,000. You just utilized 20,000. You still have 20,000 remaining with you. This you can carry forward next year. And you can carry forward, you can bring forward from the previous 3 tax years only. You can't go 4-5 years, like only up to 3 tax years you can bring forward any unused annual allowance. And remember, this unused annual allowance you can only carry forward if that individual was a member of a pension scheme for that tax year. Otherwise you can't. Let's say last year he was not a member of a pension scheme. This year he's a member. So last year's unused he can't carry forward this year because last year he was not a member of a pension scheme. So that in that case, that unused annual allowance is just simply lost. Nothing to do. I know it's bad. Now, the AA, annual allowance. When you're using it, always use the current year first. Then you are going to work on back and work on the unused annual allowances that has been brought forward. But when we do that, remember first 3 years, right? Previous 3 years, right? This works on FIFO basis, first in, first out. How? Starting with the earliest tax year. For example, this is 2023. So 2020, 21, 22. So when we are working, obviously we are bringing forward from 2020, 21, 22 to 23. We have to start with the 2020 first, then 21, then 22, like that. But first 23, current year utilize, then back for, when you go back, start with the earliest, 2020, 21, 22. It's not the other way around, 22, 21, 20. Now let us do a simple question to understand this concept.
We have 2 questions here, test your understanding 2 and illustration 3. Here, we have some unused allowances and we are going to see how we account for Steve and Mike. Steve has been a member since 2012-13. No issue. Mike joined pension scheme in the tax year 2020-21 and has a relevant earning. Both has a relevant earnings of 100,000. State maximum gross contribution that they could make without incurring an annual allowance tax charge. Okay. So 2000. So let's do for Steve first. Okay. Unused allowances. We'll see that. Now, if you check 2019-20, this year, see for Steve there is no issue. Steve has been a member since 2012-13. So all the 3 years he can carry forward. Here he has used 52,000, which is more than 40,000. So he's not going to carry forward any unused allowances. Zero. What about 2021? Yes. 40,000 is annual allowance. 25,000 he has made contribution. So up to 15,000 he can contribute more without incurring any tax. Then 2020-21. 40 minus 17 is 23. 23,000. Okay. If you add up the total 0, 15 and 23, it adds up to 38,000. And also this year 2022-23, current year he can use the allowance of 40,000 this year. So 38 plus 40 is 78,000. He can contribute up to 78,000 without incurring any income tax. Okay. Now, for Mike. Okay. Mike, you can't carry forward from 2019-20 because he was not a member of a pension scheme. He was already a member of a pension scheme from 2020-21. 15,000. So the balance 40 minus 15 is 25,000. Okay. Then 2021-22. 40 minus 6, 34,000. Add up 59,000. And this year 40,000. 2020 223, another 40,000 will be 99,000. Mike can contribute. He can make the gross contribution without incurring any income tax. Now let us move on to test understanding 2. Okay, here he has been given for 4 years. Relevant earnings of 100,000 each year. He has 100,000, not overall. State the amount of unused annual allowance to carry forward for 2023-24. Remember, you can only carry forward from the previous 3 years. You can't carry forward this year. It's 4 years previous. You can carry forward from this year, this year, this year. And when you carry forward, you have to first utilize this, then utilize this, then utilize this. 1, 2, 3. But first with this, 58,000. Okay. So now, tell me, how much? 26,000. Okay. Okay, wait a minute.
Okay, guys, I have realized a mistake done by me, and often this is done by students, that because they told state the annual allowances to carry forward to tax year 2023-24, I've been assuming from year to here. Okay, yes, definitely you can't carry forward the unused allowances, but when we are working out on the allowances available and how much has been used and how much can we carry forward, we take this year. Okay, this year, and then we work. So we start with 2022-23 current year first. Okay, we make a table. So let's quickly do that. So here first, allowance available. Then we have how much we have used and how much can we carry forward. So for 2022-23, we have allowance available 40,000. Okay, so we have used entirely the 40,000 allowance. If you see, we are at 58,000. We have used more. So we can't carry forward anything to 2023-24. We can't carry forward. Why? Because we have utilized the annual allowance completely for that. Next, we are moving backwards from 2019-20. Because from this year, 2020-23, 3 years is this, 2019-20. Because they told up to 3 years unused allowance. This year we have utilized. So unused allowance for the previous 3 years is this, this, and this. Okay, I have misunderstood. I have put another year and I thought it's this, this, and this, leaving the 2019-20 out. It's not like that. Okay, so unused allowance brought forward. So for starting with the year, always write the year 2019-20, 2020-21. In tax, year dates are very, very important. Okay, so here out of 40,000 we have utilized 12,000. That means we still have an allowance of 28,000. How much we have used out of 28? 18,000. We can utilize till 3 years. Remember, from 58, this is 3 years. So 40 and 18,000. 18,000 we can utilize from here. Balance is 10,000. But can we carry forward this? No, not applicable. We can't carry forward the balance 10,000 to 2023-24. Why? Because from 2023-24, if you see, 2019-20 is not 3 years, it's 4 years. Time limit is only up to 3 years. 3 previous tax years only. So it's more than 3 years. That's why we can't take it. The balance, the rest are easy. 2020-21 is 26,000. So 40,000 minus 26,000 is 14,000. We haven't used anything. We can carry forward 14,000. And 2021-22, it is 33,000. So 40,000 minus 33,000 is 7,000. Even this we can carry. 7,000. So if you add, the total is 21,000. This much we can carry forward to 2023-24. Okay, you can add and check like this also. 8958. Still you will get 21,000. Calculation of annual allowance charge. How do you calculate? Very simple. Add the total of all the contributions on which relief is an optant if it exists the AA, annual allowance. Okay, then there is a tax charge on the excess. When you are taking all the contributions, remember, all the unused annual allowances brought forward also is there. Okay, it also includes the brought forward annual allowances. With that, you have to check whether it is exiting the 40,000 or not. Now, the tax is calculated as if the excess is the individual's top slice of income. That means it is taxed last after all the sources of income, including dividend. At what rate? Non-savings rate. So if you have three types of income, non-savings, savings, dividend, first tax all those, and then this annual allowance charge will be taxed at the end. That means it is at the highest category at non-savings rate. Now, so the annual allowance charge becomes part of the individual's total liability. This also will be added in that total liability. Either you can pay through self-assessment or it may be taken from the individual's pension fund. Now let us do three questions on this. Illustration 4. Here you have to explain how tax relief will be obtained by Sophia, and you have to calculate her income tax liability. Okay, so she is a self-employed who has trading income of 105,000, gross contribution of 90,000, and does not have any unused annual allowance brought forward. Okay, now first you have to identify how much tax relief she will get. For that you have to take higher of 3,600 or 100% of her relevant earnings. In this case, her only relevant earning is her trading income, which is 105,000, which is, so the higher of 3,600 and 105,000 is 105,000. This you have to compare with her gross contribution, which is 90,000, the lower of the two. So she will get a tax relief of up to 90,000. Okay. Now, how will she get the tax relief in this, on this gross contribution? Sophia will pay the pension contribution net of the 20% tax. Okay. So it is 90,000 into 20%, which is 18,000. So when she pays the contribution, it will be 90,000 minus 18,000, which is 72,000. Okay. Now, even her trading income is at 105,000, which is at higher rate. So you have to expand her basic rate. Basic rate is 37,700. You have to expand this by her gross contribution, which is 90,000. This will give her basic rate now at 127,700, which is a huge benefit for Sophia because her entire income will be taxed at 20%, that is basic rate, rather than being paid at higher rate. So now, but you have to see, Sophia's gross contribution of 90,000 is more than 40,000, right? Annual allowance is only up to 40,000. So the balance 50,000, she will be charged tax. She has to pay tax on 50,000. Okay, and this will be taxed after all her other incomes, this 50,000. You have to keep this at the end last. Now, so now we'll calculate her income tax. Her trading income is 105,000. Don't forget to deduct her personal allowance. Okay, but because her trading income is more than 100,000, you have to calculate her net income. Personal allowance adjustment is based on net income, not trading income. You have to deduct your gross contribution. So if you deduct gross contribution, 105,000 minus 90, it will be less than 100 only. Because it is less than 100, personal allowance, she will be entitled to full personal allowance. You don't have to reduce, which is 12,570. And you will be having 92,430 as a taxable income. Now, when you calculate income tax, you have to be very careful. There is a 50,000 of annual allowance charge. AAC, which you have to tax. But this you have to tax only after taxing this entirely. So because basic rate is up to 127,700, this entire 92,430 will be charged at basic rate. 92,430 into 20%, which is 18,486. But out of this 50,000 annual allowance charge, some portion of it will fall on the basic charge, some of it will fall in the higher. Because if you add 92,430 with 50,000, you still have up to 127,700 to cover. So 50,000 minus the balance, which is 35,270. Out of 50,000, 35,270 could be taxed at basic rate. This 35,270 is from this 50,000. Now the balance 35,270. If out of 50,000, 35,270 goes, you are left with 14,730. 14,730 will be taxed at 40%, which is 5892. And her total income tax liability is 31,432. Okay. One thing you have to make sure whenever you get a question like this, where you have to calculate income tax liability as well as her tax relief for the pension, because it is explained, you can answer this in different paragraphs. Where first paragraph is on the relief, how much relief? In this case, it is 90,000. First, you have to decide that. Second, you have to pay the net. You have to find the net, which is 72,000. This one. Third, you have to expand the band from 37 to 127,700. Then you have to identify that AA charge will apply, 50,000. And then finally, you calculate income tax. Similar way, you have to do the other two questions, test your understanding 3 and test your understanding 4. Test your understanding 3 is about 3 separate year. You have to calculate income tax liability for this year. Okay. He has earned 100,000, gross contribution is 86,000. So if you take tax relief, it will be on this 86,000, because 100% of 100,000 is 100,000, which is higher of 3,600, and the lower is 86,000. So you will get relief on 86,000. Now you have to find the net amount. 20% of 86,000, which is 17,200, and then you deduct it from 86,000 and find the net amount, which is 68,800. And you are going to expand the band by 86,000. Add 86,000 with 37,700. Basic rate band will now become 123,700. Now you have to calculate from this year. It's a FIFO, earliest tax year first. So if you see, this year you can utilize, this year also you can utilize, but sorry, this also you can utilize, but this year you have used excess 10,000. You will be charged. So let's do that working. For 2019-20, out of 40,000, 17,000 is gone. So you can carry forward 23,000. Okay. Then 2020-21, you have contribution in excess of 40,000. Okay, you have 50,000. So you can use part of it from 2019-20 allowance brought forward to reduce the contribution. Okay, the excess 10,000. It is at 50,000 now. So that you can reduce the excess 10,000 from the previous year, that is 2019-20. Then 21, 22. Again, you can carry forward 40,000, 34,000. 6,000. If you add all the three, 19,000, up to 19,000, you can carry forward. So now when you have your maximum annual allowance is not 40,000, it is 40 plus 19,000. 59,000 will be your annual allowance. Now, so he will be taxed at what? Additional out of 86. His gross contribution is 86,000, out of which 59,000 is tax free. Excess is 27,000. On this 27,000 he'll be taxed, the excess. Okay. Now we can calculate his tax liability. His employment income is 100,000. Okay. Personal allowance. It has to exit 100,000 for you to reduce the personal allowance. If it's just 100,000, still you will get full personal allowance, which is 12,570. Now it is 87,430. So this 87,430, if you add this with 27,000, you are still below the higher rate. You are still in the basic rate band. That's why both can be charged at 20%. This and 27,000. Okay. Now, test your understanding 4. It's about Zainab. Here you have to calculate 3 people's tax relief. You have to calculate and explain. One is Zainab, one is Ali, and the other one is Ali's employer. 3 people. First, we'll deal with Zainab. Okay. Zainab is a self-employed, trading income of 115,000. Ali only has an employment income of 13,500 with income from unfurnished flat 20,000. They have a joint bank account, receive interest of 5,000. Zainab paid 49,000. Zainab contributed 38,000 in personal pension. In March for each of the last 3 years. This year she paid 49,000. Previous 3 years she has been paying 38, 38, 38. Ali paid 2,600 in occupational. Ali's employer paid 2,000. So let's start with Zainab. Okay, when you have two people like this, you have to first mention the name under which you are discussing. You have to keep them separate. You can't mix the 3 people. Zainab is separate, Ali is separate, Ali's employer is separate. Zainab, first you have to talk about the tax relief. Before that, Zainab has multiple sources of income. You have to understand what is relevant earnings for her. She has 1 trading income. Okay. And also joint bank account. So 2. But only her trading income is relevant income. Her interest from the bank account, which is savings income, is not a relevant earning. Okay, so already her trading profit will be taken as relevant earnings because bank interest comes under investment income and it's not a relevant earning. So if you take 100% of 115,000 and contribution is 49,000, lower of the two. So 49,000 is up to 49,000. She is going to get the tax relief. Now you have to find the amount. Zainab would have paid this pension contribution net of basic rate tax. You have to find that. So it will be 49,000 into 20 because 20% is tax divided by 80, which is 12 to 50. There is another way of doing this. If you are confused, first find the gross amount, then deduct it with 49,000. The difference is this. Okay, the grossing of 49,000 is into 100 divided by 80, which is 61 to 50. So 61 to 50 minus 49,000 is 12 to 50. Okay, this is the gross contribution. So you can expand the basic rate by 61 to 50. This is why we need this gross amount to expand our band. So from 37,700, if you add 61,250, it is 98,950. Basic rate band, BRB. Now, every year 38, 38, 30. That means you have utilized less than 40, 40, 40. So the 2,000, all the 3 years you can carry forward. 2,000, 2,000, because 40,000 minus 38,000. Total is 6,000. This year she can use the entire 40,000. 46,000. So 46,000 she can contribute maximum without incurring any tax. But this, if you see Zainab's contribution, it is more than this 46,000. Right? Zainab's contribution is 61,250. 61,250. Maximum is 46,000 is tax free. The balance you'll be charged tax at higher rate because Zainab is a higher rate taxpayer. 15,250. Okay. So if you charge 40% at 15,250, it is 6,100. This much tax you have to pay. And now coming to personal allowance. If you check the personal allowance of Zainab, it will be full because if you take her gross contribution and deduct it from trading income, it will be less than 100,000 only. Okay. Now Zainab is done. Now we are focusing on Ali. Ali is an employee. He has part-time job, 13,500, property income also. But please understand, only relevant earning. Property income is not a relevant earning. Okay. Therefore, 100% of 13,500 he can get relief. But he has contributed 2,600, lower of the two. So up to 2,600 he will get tax relief. Now, what will Ali do and what will Ali's employer do in the case of Ali? Remember, whatever Ali's employer has contributed, this 2,000, it is tax. It has nothing to do with Ali. It is a tax-free benefit. And Ali's employer will deduct this gross contribution of 2,600 from Ali's income, Ali's employment income, before calculating income tax liability under payee. This 2,600 will be deducted first from his employment income. before calculating tax. Now, Ali's employer. Ali's employer will obtain tax relief for this 2000 contribution he has made. And how this relief will be given? It is given as an allowable deduction. That means when Ali's employer will calculate his taxable trading profit, that time he can deduct this 2000 as an allowable deduction. That is the way how his employer is going to get the relief, tax relief.
Now, there is a restriction of annual allowance for high income individuals. How? We have restriction on personal allowance above 100,000 of net income, right? This annual allowance is gradually reduced for individuals with high income. This restriction applies for individuals with adjusted income more than 240,000. Okay, you have to know how to calculate adjusted income. This restriction operates in a similar way to the reduction in personal allowance for high earners. If you know that how personal allowance is reduced for high earners, you will understand this as well, because it operates in a similar way. Annual allowance is reduced like this. This is a formula. You have to remember this. Whatever your adjusted income, deduct 240,000, the difference multiply by 50,000. That's how much you have to reduce your annual allowance by. That means from 40,000 you have to reduce this amount, because it says reduced by, not reduced to. If necessary, you can round up or down to the nearest pound. Okay, the annual allowance. It's advisable to do so in your exam. Minimum amount. There is a minimum amount that an annual allowance can fall up to. It is 4,000. Beyond 4,000, you can't reduce your annual allowance. If it's, let's say, after doing this formula, adjusted income minus 240,000 into 50%, you are getting 3,600. You have to bring it up to 4,000. If it's from 3,000, again it will come up to 4,000, because the lowest is 4,000. Then this is how you calculate adjusted income. Your net income, you will get it from your income tax computation plus individuals, employees, occupational pension contribution. It has to be in the occupational pension contribution, okay, from employee, and also employer. For employer, it could be any scheme, personal or occupational. When employees are contributing, that you have to add for that individual. Then you get adjusted income. This adjusted income you compare with 240,000 and find out where annual allowance has been reduced for high income individual. If it's reduced, then that reduced annual allowance only you have to compare to the actual contribution in the tax year to decide whether you have any unused annual allowance to carry forward or not. Then it's not with 40,000. Then it's with whatever that upon. Let's say it could be 36,000, 25,000. You compare with that and then you decide whether you have any unused annual allowance to carry forward. Now, where an individual's adjusted income is 312,000 or more, annual allowance is reduced to 4,000. Why? You can check this by using the formula. Take 312,000 minus 240 into 50%. You'll get 36,000. So 40 minus 36 is 4. That means anything more than 312 will be less than 4,000. Right? So the rule says it can't fall below 4,000. That's why, in short, you remember this, that if it's 312 or more, annual allowance is 4,000. And remember, adjusted income for annual allowance and your adjusted net income for personal allowance are not same. They're different. And the way you calculate them are also different. So do not mix these two. This is different, that is different. And when you're calculating adjusted income, you don't deduct gross gift aid donations, or you don't deduct gross personal pension contribution. You do this when you're doing for personal allowance from net income, but you don't do here. And rather you add, here you add employer's pension contribution to the net income. You do here in annual allowance. So now let us do two questions on this restrictions of annual allowance for high income individuals.
Illustration 5, annual allowance for high income individual. You are been given three different individuals with employees contribution, employers contribution, and their taxable employment income. Now, and they have no other sources of income. You have to calculate the annual allowance for each individual, assuming they have no unused allowance brought forward. Let's start with Anne. Anne has taxable employment income of 200,000. This is 310 and this is 250. All of these three are into additional rate taxpayer. Okay. Why are we working on additional rate taxpayer? Because we want to show how do you reduce the annual allowance from 40,000. And it's only applicable for high income individual, not for basic rate taxpayer. So for and we first have to find the adjusted income for all the three individuals. Adjusted income. And the formula for adjusted income is take your net income. In this case, your net income is your taxable employment income only. So for and, it is, right, and it's 200,000. This is the net income, NI. Then you have to add employers and employees contribution into it. Both 30,000 and 5,000. For all the three, you have to do in a similar way. 30,000, 5,000. The addition of it is 235,000. Okay. Now, this 235,000 you have to compare with 240,000. It is less than 240,000. So if it's less than 240,000, you don't have to reduce your annual allowance. You will get full annual allowance, which is 40,000. So in the first case, you don't have to reduce. Your annual allowance is 40,000. Second, Belinda. Belinda has 310, 8 and 2. So 310 plus 10 is 320,000. 320,000 is the adjusted income, which is more than 240. Here, your annual allowance will reduce. Okay. So deduct this with 240,000. Okay. So 320. You don't have to deduct this with 240 also, because it's more than 312,000. The moment it's more than 312,000, your adjusted income, your annual allowance is 4,000. So in this case, annual allowance is 4,000. And in the third one, for Carol, it's 250, 12 and 20, which is 250 plus 32, 282,000. 282,000. It's more than 240, but it's less than 312. So 282,000 minus 240,000 into 50%. It is 21,000. This 21,000 you have to reduce from 40,000 because they told this is reduced by. So 40,000 minus 21,000 is equals to 19,000. 19,000 is your annual allowance for this year for Carol. It's more than 4,000. Okay. Now, let us do test your understanding 5, and it is similar to the previous question. Here we have two people, Axel and Ingrid. Axel has trading profit of 240, taxable saving of 5,000, and gross personal contribution of 40,000. Ingrid has annual salary of 290, dividend of 8,000, 10% salary is paid into employees' contribution and 5% is paid by the employer. Same, calculate annual allowance and assuming no unused allowances are brought forward. So let's do for Excel. Adjusted income. First, we have to find the adjusted income. Always starting as adjusted income for high income earners only. The moment you say it's high income, you have to see to it that you calculate adjusted income. Otherwise, you are going to lose marks here. You can't calculate annual allowance. So 240. With 240, you can take the savings income also. Add 240 and the savings income. 240 plus 5 is 245,000. So this 245,000 is more than 240,000. That's why your annual allowance will fall. 245 minus 240 into 50%, which is 2,500. This has to be reduced. Don't forget to deduct the amount after this formula. The amount that you get, always you have to deduct it from 40,000. This is not the final answer. 40,000 minus this is the answer. 37,500. This is the annual allowance for Axel. Now, let's do for Ingrid. Okay, Ingrid's income is 290. Add dividend with it. But before we do that, remember he has a salary and they told that 10% of her salary, she paid 10% of her salary into her employee's occupational pension. Because it is 10% of her salary, before you add dividend, you have to first deduct 10% of salary from salary. So salary is 290,000 for Ingrid. Deduct 10%, which is 29,000. Then you are left with employment income, which is 261,000. Now you can add your dividend, 8,000, which is 269,000. This 269,000 is your net income. It is not your adjusted income. You have to make this to your adjusted income, because adjusted income only you compare with 240,000. You don't take net income. Now, remember for net income, you have to add both employer and employee's contribution. And it's on salary. It is not on net income. So 10% of employee, 5% of employer, together is 15% on 290,000. Because both are on salary. So 15% of 290,000 you have to add, which is 43,500. It is 312,500. This is the adjusted income. Okay. Because this adjusted income, they told if adjusted income is 312,500 or more, it's more than 312,000. Annual allowance is 4,000. Because this is the minimum amount. It can't go below 4,000. This is the last section of this lecture, which is assessing the pension fund. Once invested, funds in the pension scheme are accumulated and they grow in value, tax-free, as the scheme is exempt from income tax and also exempt from CGT tax, that is capital gain tax. How it is exempt from income tax? In respect of any income that is earned from the assets invested in the pension fund. And how in terms of capital gain tax? Because in respect of any capital disposal that is made by the trustee from this fund. Now, funds held in a pension scheme falls outside the death state for inheritance tax purpose. So pension scheme does not fall within the scope of death state when we calculate inheritance tax. Inheritance tax I haven't covered here. We'll cover that later. Okay. The funds in a pension scheme cannot be assessed by individual until they reach the pension age. Okay, the minimum pension age is 55. It cannot be below 55. So you have to be 55 or above to assess the fund from the pension scheme. Now, for those individuals who are in a defined benefit scheme, or you can say occupational pension scheme, the benefits are linked to the level of earnings of that employee. And if you are under money purchase scheme or personal pension scheme, then the benefits are dependent on the amount of the fund that has been accumulated in that scheme. That is contribution plus investment gain. Individuals who are dealing with money purchase, that is personal pension scheme, they have a flexibility in how they are going to assess the accumulated fund. How? This is the way how they are going to have that flexibility. They can withdraw 25% of the fund as a tax-free lump sum. That is tax-free. Lump sum means a huge amount at once you are withdrawing. Up to 25%. The balance 75%, it can be assessed in a variety of ways. You can purchase an annuity. Okay. Then withdrawals from the balance of the fund then will be taxed as at non-savings income at 20, 40 and 45%. Now, lifetime allowance. There is no restriction. Okay, earlier I have covered that there is no restriction on the total contribution. Any person can contribute any amount. But the tax relief is limited. There is a limited amount on which a person is going to get tax relief. Why is it? This is in order to prevent wealthy individuals from accumulating large sums in a pension fund and grow as tax-free. In order to prevent them, they have put a limit. That this is the amount up to which they are going to get a tax relief. Beyond this, you will be charged tax. So there is a maximum limit to the amount that an individual can accumulate in that pension scheme tax-free. This is known as lifetime allowance. And the lifetime allowance for this tax year 2022-23 is 1,073,100. This, you have to remember this amount. It's given in your exam tax tables. And this is considered when a member becomes entitled to withdraw that benefit out of the scheme. If the value of the pension fund exceeds the lifetime allowance, income tax is charged on the excess. For example, if the amount is more than 1,073,100, excess will be charged. Income tax will be charged on the excess when the individual withdraws that fund from the scheme. Now let us do some practice objective test questions. So we have test your understanding 6 till 11. Test your understanding 6. How much of the basic rate band will be extended for Lux? He has a profit of 70,000, paid personal pension contribution of 22,000. Okay, remember, whenever you are given an amount that they have paid personal pension contribution, you have to assume it is net. It is the net amount. You have to gross it up. You can't take 22,000 and expand the basic rate band by 22,000. This is the net amount because we always pay net. So how do you gross it up? 22,000 into 100 divided by 80, which is 27,500. So the correct answer is C. You are going to expand your basic rate band by 27,500. Test your understanding 7. Which of the following statement is incorrect regarding employer's contribution? This is why you have to cover your entire syllabus not just the calculation part, because you have MCQs in your exam and you have to know, you have to read word by word to know what is correct, what is incorrect, what is true, what is false, what is yes, what is no. That means you have to know the correct statement to know what is incorrect. First one, A. Employer's contribution are tax deductible in calculating employer's taxable trading profit is true. Employer's contribution are an exempt benefit for the employer is true. Employer's contribution are included in annual allowance available to employee. It is true. Employer's contribution are deducted from the employee's earnings when calculating the tax to deduct under payee. It's not correct. This is incorrect. So the correct answer is D, because this is the incorrect statement. Test understanding 8. You have to find the personal allowance. Net income is 119,500. Gift aid is 2,400. Already they wrote gross amount, so do not gross it up. Personal pension contribution 10,000. This is also gross. So what do? You just simply deduct from 119,500. You deduct first gift aid donation 2,400. You further deduct 10,000, which is personal pension contribution, and the amount is 107,100. It's more than 100,000, right? So minus 100,000 into 50%, which is 3,550. Your personal allowance is 12,570 minus 3,550. It is 9,020. So the correct answer is B. Same way, test understanding 9. But there's a trick here. The trick is he earns 115,000 and he paid personnel of 5,600. Lot of you will make the mistake of deducting this from this, but you didn't pay attention that they haven't mentioned gross here. Whereas in the previous question, they clearly told this is gross. Personal pension contribution of 10,000, gross in bracket, they will write it. If they don't write, it's net. So you have to gross it up. You can never deduct the net value from the earnings. It has to be the gross amount. So first you have to gross it up. 5,600 into 100 divided by 80. It is 7,000. This 115,000 now you deduct by 7,000. It's 108,000. Then you deduct from 100,000 into 50%. This formula you have to remember of personal allowance, which is 4,000. Right? So from 12,570, 4,000 is reduced. How much? 8,570. So the correct answer is D. Test understanding 10. This is about personal pension scheme. Who can contribute in the scheme? Jasper only, Jasper and his employer, Jasper, his employer, and Jasper's self-employed wife, Jasper and his self-employed wife only. It's C. Because it is personal, anyone can contribute. Okay. And the last question. This is regarding maximum gross pension contribution that they can pay without having to pay tax. Okay. He's employed, part-time earning 2,500, property income is 25,000, dividend is 10,000. Remember, for relevant earnings, unfurnished house, this is not a relevant earning. Dividend income is not a relevant earning. Only this 2,500. Okay, so you have to take the higher of 100% of relevant earnings, which is 2,500 and 3,600. Higher is this, and they haven't mentioned anything, right? So the maximum gross pension contribution they can make and receive tax relief is 3,600. B. So that's it for this lecture. Now we have come to the summary of this lecture. We have started with pension contribution, which could be paid by individual on one side and employer on the other side. Now, if it is paid by individual, the tax relief is lower of gross contribution paid, which will be given, and maximum annual amount, which is higher of 3,600, which is fixed, and 100% of your relevant earnings. Now, in your exam, they will give you multiple source of income. You have to decide out of which one is the relevant earning. Not every earning given to you is relevant earning. For example, you could be given dividend, you could be given savings, you could be given property income. All those are not relevant. Okay, your relevant incomes are employment income, trading income, any source of investment income are not your relevant earnings, 100% of that. So that you compare with 3,600, whichever is higher, and then you check the lower of gross contribution paid and the maximum annual amount. For paid by employer, whatever the amount employer pays, he will get the tax relief, provided it is given for the purpose of trade. Then this is further divided. Individual can contribute in personal scheme and occupational scheme, whereas employer can contribute in both occupational or personal. If it's personal, whatever the payment given to you, it's always paid net of 20% income tax. If it's gross, they will give you its gross. They will write it in bracket that this is gross. We have done questions. And occupational schemes are always paid gross. Always paid gross. You only have to worry about personal scheme, whether it's net or gross. Occupation is always gross. Then, how are you given the relief? At 20%. And for higher and additional rate taxpayer, the relief is by extending the basic rate and the higher rate band. By how much? By whatever your gross contribution paid is. Gross. It should not be net. If it's given the net, because personal schemes are given net, first gross it up, that amount you add with the basic rate or higher rate band and then extend. Then for occupational, which is paid gross, tax relief are given at all rates. Okay, and it's also given as an allowable deduction from employment income. When you calculate your employment income, you deduct this from there. For employer, this is also given as an allowable deduction in calculating their tax adjusted trading profit. And for employee, whatever employer contributes into the scheme is exempt. And together, whether it is personal pension scheme by individual, occupational pension scheme by individual, or it is paid by employer, annual allowance works in the same way. How? Add all the total pension contribution, check whether it is exceeding the annual allowance, which is 40,000. And on excess, you'll be charged tax. But you also have to take care of any unused allowance that you can carry forward from 3 previous tax years and earliest tax years first. So you add unused allowance with the 40,000 and check how much are you exiting. And also for high income earners, this 40,000 is adjusted. It can reduce up to 4,000. It cannot go below 4,000. 4,000 is the lowest. So overall, this is the whole summary on pension. Now make sure you pick up the revision gate questions and start doing questions from pension. Thank you for watching, and I shall see you in the next lecture. That is capital allowances, again, which is under income tax. Thank you.